Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Thursday, September 22nd. Okay, looking at the S&P 500 cash index, day 2 into the Yellen non-action here, and the market is looking at this and saying, man, we get 3 months where we know the Fed is not going to do anything because the next scheduled Fed meeting is not until the early November timeframe. Do you think there's any chance whatsoever that the Fed is going to raise rates or change any kind of monetary policy literally a few days before the main election? There's no chance. So really their next opportunity is going to be midway through December. So that's about 3 months from now. So the market's like, whoo, party time. But in reality, really nothing has changed, especially since the Brexit low. Since the Brexit low, and if we zoom in on this area here, we were in sideways and volatile price action, really from August. Well, actually, this even started back in October of 2014, 2 years ago, right? So we got that initial shock out of the way. But really, the volatility started back in August of 2015, so just a little over a year ago, and was all over the place until we got through the Brexit. And then we popped back up here, and the volatility and the stuffing has just come right out of the market ever since. So I think there's still a good chance that we've made a transition from sideways and volatile markets to quiet and trending again. This is what we're seeing in the most recent market. This is anything but sideways and volatile up here. So what's next in markets? Well, I do believe in Symmetry, and I have been watching this for a while. So when we drop down like that, imagine throwing a rubber ball at the concrete as hard as you can. And what we're going to find is that a lot of that energy gets reflected right back up again. And then we go from range expansion to range contraction like we normally do. And then what we saw was that move get thrown to the downside again with the Brexit news that came in. Okay, so that stoked up a lot of negativity, which got run out of there. And then we basically jumped about 150% higher from that move. The length of the pullback, the rally after that was about 150% of the initial down move here. So now we're doing the same kind of thing again. And if we just look at this negativity from this 70-point move down, if we do 150% of that, we get up to somewhere around 22-25 or so. So each of these reactions is getting smaller and smaller and smaller, and I think we might be heading towards this sort of stair-stepping price action, which is really kind of just grinding. We occasionally get a pop higher from here. We saw this a lot during this era here. We saw a lot of it during this move back here. All right, so we've seen this from time to time, and actually most of the time the market trades, you do see quiet and trending price action. So if we're going to see stuff like this going forward, and there's no guarantee that we will, but the one thing that I do know is that before markets sell off, they will start to get very noisy again. So they'll start to see big moves in volatility. So the actual realized volatility will kick in again. Not this stuff. This is not where markets sell off from. They don't do it from here. Right? So markets that have this type of price action typically just keep grinding higher like this stair-stepping movement. So what kind of strategies can we trade in this type of market? Well, the bread and butter is going to be back to our vertical spreads, the directional vertical spreads, where we're looking at a 1-to-1 reward to risk on the trade. So in those types of markets, we're going to look for larger time frame trends to match up with what we see on the signal chart, which is going to be in the daily chart. So we're going to take our signals off of the daily chart for these trades, and we're going to be looking for bullish and bearish opportunities depending on what the chart shows. But these are still ideal trades for this very low volatility. The other type of trade that I want to look for is a put credit spread. So this is half of an iron condor. I just don't think that setting up call credit spreads in this type of market is going to be very successful. With the very low volatility that we have, we could literally be in trouble in just 2 days. And this is one of the big problems that I had during this time frame here where markets just kind of ground higher mercilessly, and we started off with such a small distance on those short strikes for the call spreads because of the compressed volatility. So what we do is we patiently wait for some type of pullback. The deeper the better. And the pullback, the point of the pullback is to jack up that implied volatility high enough that we can sell strikes below support. So that's the whole point here. Any trades that I have right now would still be ideally underneath the Brexit low right now. And this pullback was just not enough. I mean, I wanted 2100 or better, and I didn't get it. So sometimes we're going to swing and miss on these types of trades. The third style of trade that we want to continue doing, because when we get markets doing this sort of thing, we get complacency, and big movements can come from complacency, as we saw many times over the last 12 months, right? So some of these movements were really just massive, and properly positioned, you can do very, very well with them, as well as hedging your long portfolio, certainly. So we want to continue to look for opportunities to stay in those trades. You have to be in it to win it with those types of downside hedge trades. Number 4, we can continue to build inventory. So whether that's long inventory or short inventory, most people are more comfortable with long inventory. But my gosh, we cannot leg into, we cannot start to build an S&P position up here at 2200. It's just we have to wait for some kind of event, some kind of pullback. I mean, if we were really looking for that move down to 1600, that would have been great. Would have been a great reset button for the market. Just didn't do it. Just didn't give us a chance to do that. So we did have some opportunities as the price came down here to 1800 to sell assets that were priced around this level, right? So that worked out really well for us, but just rarely. So we may have to go fishing for assets. With most stocks, I believe the latest number I saw was over 70% of the S&P 500 is above the 200-day moving average. Well, that's great, but I really want to be buying assets or legging into assets through selling puts that are at deep discount today, that I'm a willing buyer if the price comes down there and assigns me. And then finally, what we want to be doing here is long Vega positions, and these to me are kind of a replacement for the iron condor. So if we can't be doing a lot of the high probability iron condor stuff, we can be doing kind of the equivalent trade with a time spread. So specifically a calendar spread traded right at the money is going to have this type of risk curve to it. So it's going to have that similar frown to it when we sell an option at the money like this. And what's great about these types of trades right now is that it's positive Vega. So positive Vega means that if the implied volatility actually rises from here, what you'll find is that the profitability envelope of the trade will actually grow. So the expiration envelope of the trade will actually grow, as will typically the realized profit and loss as well too. So this is a case where this is kind of opposite the iron condor, where iron condors, of course, are short Vega, but what we don't have in an iron condor is the risk expiration graph does not move. Once you place the trade, your profit and loss is pretty much set at expiration for that. But not so with the calendar spread. So there's some good things about that, and there's some bad things about that we have to avoid. So it's a little bit trickier to set these up, and it's a little bit mechanical to manage them, but these can be a very effective trade if we do get into this sort of stair-stepping type of price action. So we look for the swing back up there and set up the time spread right at this point here. So right into that rally, we set it up, and then if we do everything right, the price just kind of walks sideways for a few days, and we're in and out with our fair share in no time at all. Now, this is not to say that we can't have some aftershocks coming into this market, but right now, I think the market thinks that it's got a free pass for the next 3 months, and I intend to trade it with that in mind. Again, you can't trade the market that you want, only the one that you have in front of you, and this to me is where the edge is available to us. So with that, that is tonight's report, and don't forget to catch us this weekend. Take care, folks.